Hi, welcome to Debits and Credits. Today I will teach debits and credits a little bit different than the book to hopefully help you learn in a new way. My way is not by any means the way you have to learn, but I'm just trying to aid your learning. As we talk about debits and credits, we talk about expenses, assets, and dividends. Expenses are things you spend money on but don't have anything physical to touch. Examples of this would be your cost of goods sold, your rent expense, your office expense, your wage expense, your utility expense. You physically get to stay in your office building every day and you pay rent expense, but you can't physically touch your rent expense. It goes to someone else and they just allow you to stay there. The next one is assets. Assets are things that you spend money on and you can physically prove that you have in your being. So as we think of assets, we think of things like cash. You could go get all your cash out of the bank. You could require everybody to pay their accounts receivable. You can physically go touch your inventory. If you actually own your building and you're not just renting it, you can physically touch your building. Assets are things that you can physically touch. Dividends is money paid to shareholders. Shareholders are the people that invest in your company, and because they invest in your company, you try to pay them dividends to keep money in your company. So it's common that a shareholder can receive a certain percentage of the money that you make, and you give them a percentage back based on the money they've invested. Now, as we look at these expenses, assets, and dividends, you can see that I have spelled the word dead. DED stands for debits, expense, assets, and dividends. So these three accounts, expenses, assets, and dividends, will always have a debit balance. Now we're on to liabilities, owner's equity, and revenue. Liabilities are things that you buy on credit or expenses that you are going to pay in the future. Some examples would be accounts payable, notes payable, wages you owe to employees at a future time, or taxes that you owe to the government at future time. Owner's equity is the money that has been invested or that is left over after all expenses have been paid. So examples would be common stock. That's where we keep track of the money that has been invested by our stockholders. Dividends is the money that we pay out to them. Owner's capital, money that the owners put in, and retained earnings is finally our calculations of all of these items together. Last, we have revenues. Revenue is money that you've earned for the product or service that you have provided. There will be different ways that this will be stated. Some will say sales revenue, others will say service revenue. Some of them will just say sales. Some will say service, and they just expect you to know that that is a revenue. Now, as we look at our liabilities, owner's equity, and revenue, we're going to bring the word credit in. Each time I teach this, I really hope that nobody out there has the name Chlor, because as I'm teaching this has no meaning to anybody that I know. This is just how I learned and how I remember it. So credits, liabilities, owner's equity, and revenue spells Chlor. Liabilities, owner's equity, revenue all have a credit balance. So if we bring this into the T account, we can see that this account has been set up to look like a T. The book has said in their roundabout way that all debits go on the left side of our T account and all credits go on the right side of our T account. So if we look at this and we put our acronyms in, each time we want to increase an expense, we are going to debit it. If we want to decrease an expense, we would credit it. So the normal balance of the expense, assets, and dividends is on the left, and it is the debit balance. The normal balance of the liabilities, owner's equities, and revenues is on the right, and it is a credit balance. So let's look at this and see how we can make this work. We also need to remember that every business transaction has to have a debit and a credit. Accounting likes accountants like things nice and perfect, so everything has to equal. Every transaction has to have a debit and a credit, and all debits and credits in that transaction have to equal. So let's bring in some examples here. A good way to do this is, if you cannot remember the dead chlor, just write this down on a little piece of paper. When you first sit down to a test, write this down, and you'll be able to reference back to it at any point, and this will soon come easily. I had to use this for the first while of accounting, but now it's so natural in learning, it's became a second language, which accounting is the language of business, and it is like learning a foreign language, that I no longer have to write this diagram down. But anybody I've taught this diagram to instantly is able to do transactions much faster. So our first transaction is we received $5,000 and issued common stock. So this means an investor has paid us $5,000. You can see that I have brought two T accounts in. The T accounts are labeled cash and common stock. So if we have received money, cash is considered an asset, so we want to increase our asset. We know that to increase our asset, it has a debit balance, so we bring our $5,000 debit in. You can see that I've labeled this with a 1, so we can keep track of the money as we go through. Now, if we have issued common stock to shareholders, we look at our chart and we know that common stock is under owner's equity. So we will have a credit balance under common stock. Now as you look at this transaction, we have a debit and a credit, and everything balances is nice and neat, so this transaction is complete. The second one is land. This time we are purchasing land for $1,000. Land is an asset. To purchase land, we are going to increase our asset, so we will debit it. But this time we have spent money. We have spent cash to receive our asset. So the opposite side of this, if we want to decrease an asset, we know that we have to credit it because assets have a normal debit balance. So we bring that in as a credit. So we can see once again that we have our debit and credit and everything is in balance. Item number 3, paid $200 for office expenses. First, we want to look and we see that expenses have a debit balance, so we bring in our debit for office expenses. Then we know that we have to decrease our cash, so we will credit cash. We can see once again that we are in balance. Item number 4, we are going to purchase inventory on account for $1,500. Inventory is considered an asset, so we will increase our inventory, so we know we have a debit, and we are acquiring this inventory on account. So that means we're not paying cash for it this time, but we are acquiring on an account, which will go under accounts payable. Now if we look in our diagram, we know that liabilities, or our accounts payable count, has to have a credit balance, and we are increasing it, so we will bring in the credit to accounts payable. Now as we have done this, you can see that we've gone through and we've labeled each account. Now to total our T accounts and see what our ending balance is, we draw a line under the last transactions, and then we can total them. If we take $5,000 worth of cash minus the $1,000 that we spent on land, minus $200 that we spent on office expense, our new balance of cash is $3,800. We can continue through this for the other accounts, and you can see that we can designate each balance of our T account. Now we could take this information and create reports from this point. But let's look at another example. Accounting doesn't work with T accounts. T accounts are very useful, and many accountants draw them out before they make their journal entries on complicated transactions, but the way to enter each piece of information is through a journal entry. So we will bring in our common acronym of debits and credits for T accounts, and we will start with our transactions. Now these transactions are the exact same that we just did on the T account slide. We are receiving $5,000 and we're issuing common stock, but you can see now it says on April 1st. The proper way to create a journal entry is to always put the label first. Then we bring in our debit, and our debit is cash because we received cash. Next, we bring in our credit, which is common stock, and you can see we brought the money in. Now, the way to know in journal entries your debit from your credit is you can see that the credit is indented a couple spaces to distinguish the debit from the credit. So we can look at this journal entry and instantly know that our cash is debit and our credit is common stock. Now, it is common to put your debits first in a journal entry and your credits second. All professors prefer that. It makes it easy to view, easy to know if there's a mistake. It's also a very common practice in business to do it this way. So just remember, debits are first, credits are second. Just like our T account, we always read from the left to the right in the English language. Now let's look at our item number 2. We purchased land for $1,000 on April 8th. We bring in our date. We bring in our debit of land for $1,000, and we bring in our credit to cash for $1,000. Once again, we can see our debit is land, and then we have our indent, and our credit is cash. Our third transaction is we pay $200 for office expenses on April 15th. We bring in our date, followed by our debit, which is our office expenses, because we know from our acronym T account that to increase an expense, we need to debit it. And then we use the cash to pay for that, so we are going to credit it to decrease our cash or our asset. Lastly, we purchased inventory on account on April 22nd. So we bring in our date, followed by inventory, which is our debit, because we are increasing how much inventory or how many assets we have. And then we credit accounts payable or our liability, and we know that that has a credit balance. Now, as we talk about the order of accounting and the way things need to be done, we first have to have a business transaction occur. That would be the purchasing of land or the receiving of cash from the common stockholders or the shareholders. Next, we have to journalize the transaction, which is just what we did. We showed you how to journalize each transaction properly. Then we take this journalized transaction and we post the journal entry to account ledger. Now, the journal entry or the account ledger looks somewhat like a T account, and it's the same concept, but it's an actual physical ledger that you post to, and you can see examples of this in your book. When we do this in an accounting system, you journalize the transaction and the accounting system automatically posts for you. But to allow you to learn how to find mistakes and research, when you learn, we show you the long way of how you have to physically post to your account ledger. And then last, you can take these trial balances, you can take these account ledgers and create a trial balance. And this will help prepare you for your reports. As you're evaluating your trial balance for errors, you need to bring back once again to your T account acronym. All of your items that are expenses, assets, and dividends should have a debit balance. All of your credits, which are liabilities, owner's equities, and revenues, should have a credit balance. As you total up your trial balance at the bottom, your debits will equal your credits. If you do not balance, you have made a mistake and you need to go back. It's a common thing. I worked for a company for a while, and there was a lady there that just didn't understand debits and credits. I don't know how she'd gotten so far in life. But all of her liabilities had a debit balance, and that was a mess to clean up. So as you look at this, this is how you can remember which has a balance of where and where it should go. That's the end of our presentation. I hope that you've learned something about debits and credits a little bit different than is taught in books, and that you can go back and continue to listen to this until debits and credits